Hi everyone, hope you're having a good day today. Today in our class we're going to finish off chapter 13, which is talking about internal control over the payroll function and over what we call the production process. The other day essentially we talked about the payroll process itself, paying people and the controls that management should have in place over the payroll process and the types of testing that auditors perform. Today we'll cover off the production process. And the production process, when we think about that, we can see the current PowerPoint that's up here, which is on, if you're following along in the text, we're at page 589. The production cycle includes transactions that flow through the following business activities. So if you think about operating a manufacturing plant, for example, we have to plan production. And we're going to plan production based on our projected sales. We're going to have a certain amount of inventory on hand in order to fulfill those sales. So we have to try and match production with sales, of course. In the manufacturing process, normally we need some form of raw materials. So we're going to be involved in purchasing goods. And often, of course, we're going to need services performed in a manufacturing setting. So we're going to need people working, right, to produce a product. So we're going to have some labor costs to account for. And then all of these costs, the material costs, the labor costs, and indeed our manufacturing overhead costs have to be recorded and properly accounted for in the general ledger and ultimately the financial statements of the business. So we're involved here with respect to accounting for all of the costs that are being incurred and essentially allocating those costs between various inventory accounts, raw materials inventory, work in process inventory, and finished goods inventory, and then of course also cost of goods sold. So we can sort of add up all the costs that we incur during the course of the year in a manufacturing setting and allocate those costs amongst the four different components, the three inventory levels, raw materials, work in process, and finished goods, and then as well, of course, cost of goods sold to reflect the costs of goods that were actually sold during the accounting period. When we think about the production cycle itself, in terms of starting from day one and proceeding forward in terms of actually manufacturing goods, we essentially have two items that we have to consider accounting for. And if we just think very simply about the inventory of a business, how would we calculate the amount that inventory is going to be recorded at in our financial statements? Well, we would have to know how many actual units of inventory do we have, right? So we see in the PowerPoint, it says think of the audit of inventory as two phases. How do we verify the physical units that are on hand? And then physical units, of course, will be multiplied by the cost per unit. So in order to have an accurate inventory, we need to have a system that ensures that we have the number of units properly determined and also the unit costs properly determined. And unit costs, again, keep in mind, consists of not only labor costs and raw materials, but also, of course, manufacturing overhead. Now, the various controls that we should have in place with respect to the production process, this starts on page 592 in the text. But before we look at that, let's look at page 590 for a minute. So if you turn to page 590 in your textbook, you'll see that it has a picture in terms of the production process or the production cycle. So before we actually review the controls that should exist within that cycle, let's make sure we have a common understanding of what it is we're actually talking about. So at the top of page 590, you see a diagram there, and you'll see going from, again, starting at the top of the diagram where the button is, says start here. We go through the production planning cycle based on our sales forecast. We have to have inventory in order to fulfill the sales. Part of acquiring inventory, of course, as we already mentioned, you have to buy raw materials you have to acquire labor. You're going to have a manufacturing plant, right, in which to actually produce the inventory. And then you're going to go actually through your production process. People will be working, so you'll be paying people wages. You're going to be generating revenues as you sell products. So we've already talked about the revenue cycle previously. As we produce our inventory, that inventory will either be held on hand, so we'll have the quantity of units that we have to track, right? How many units we're actually producing, so we can monitor units and try to match that with our sales, right? If our sales are running higher, we have to speed up our production process somehow. If sales are running slower, we want to be able to slow down our production process, right? So we have to be able to match sales and production as we proceed. And then, of course, obviously, once goods are actually in process, we have to account for all the costs. So you see, there's all kinds of cost reports that are produced in order for management to be able to properly monitor the actual cost of the product they're producing. Because if you think about making a profit in a business, you're going to sell your particular inventory for a certain amount of money, and you plan on your cost, right, for each item being a certain amount of money. So maybe your sales price, for example, is $100 per unit, and you estimate your cost at $60. Well, during the production process, you want to monitor, right, that cost to make sure it's not moving too far off of $60. Because if it does, of course, you're going to not make your profit at the end of the day. So if costs run higher than $60, you're going to make less profit. If costs run lower than $60, you're probably going to want to look, why are our costs lower than what we estimated? As long as the quality, right, of the product is being sustained, it's probably okay. But again, a lot of work goes into determining what the unit cost should be, and then monitoring that throughout the production process to ensure that that target cost is actually determined. And then, as we already mentioned, as we incur these costs, we have to allocate the cost between the various inventory accounts, again, raw materials, work in process, and finished goods, and account for the costs which have cost of goods which have been sold. Right? So it's a matter of just taking our total cost incurred in an accounting period and now allocating it amongst those various buckets. Okay, and this particular PowerPoint with respect to controls that should exist within the production cycle. Again, this is on page 592. If you turn to that page, that's where the authors start talking about the controls that should be in place. With respect to authorization, right, of the production process, part of the control over inventory costs is we should have a sales forecast, right, before we even start to produce anything. We have to know how much we're going to sell in order to know how much we need to produce. And of course, we need to be able to match production with sales in terms of if once we know the number of items that we need to produce, that's going to be our inventory, isn't it? From which we're going to actually sell items. Again, with respect to the quantity of inventory we have to produce, that'll guide us in terms of how many people will it take to produce that inventory. How much do we have to purchase in terms of raw material, right, in order to produce that inventory? So all of the production plans, right, that we're going to put in place are heavily dependent upon the sales forecast. Okay, so doing the sales forecast first, and then coming up with an actual production plan in terms of what's it going to cost to actually produce these units. And of course, we need to figure that out before we actually start producing the units, right? We just sort of don't jump in there and start spending money without knowing what it's going to cost at the end of the day. When we actually use materials in the plant, we have something called a bill of materials. And so we purchase raw materials, but we just don't throw them into the production process. When we buy the materials, they come into our plant, they're stored in a part of the plant. And then when the production people need goods, there'll be a bill of materials prepared, which means that to produce 100 units, you need maybe, 10 pounds of this raw material, 5 pounds of that raw material, whatever those components are that go into the actual product. Those items are requisitioned from the storage area of the plant. So that comes back into, of course, custody, right, over the actual goods themselves. And of course, we can talk about custody, not only with respect to custody over raw materials that need to be controlled, but of course, custody over equipment, right? That's in the plant. We don't want our equipment disappearing. And how about custody over labor? Who's controlling labor, right, while the production process is actually going on? Is there adequate supervision, for example, over the labor? If there's adequate supervision, that will help to control costs, because that'll make sure that people are actually doing the work that they should be doing, right, during the production process. And supervisors as well will be able to monitor the actual use of the materials, make sure they're not being wasted, right, during the actual production process. So supervision, right, is a pretty important aspect of custody. Again, custody over raw materials, custody over the people, right, that are actually doing the production work, and custody over our equipment that we own in the business to ensure that it's not disappearing somehow. Because, of course, that would increase our cost of production if we had to constantly replace perhaps smaller tools and those types of things. That would be disappearing. Okay, with respect to record keeping is obviously a very important control as well. All this again is discussed on page 592. Looking at the PowerPoint, it says when production is complete, production records, including the production orders, the materials, and the labor records are sent to the accounting department. So accounting is going to be able to see what was the quantity of raw materials that was used, right? How much labor was used to produce the product, and then that information is going to be costed, right, in the accounting department. In order to ensure proper accounting over the costs, however, again, here we come on the PowerPoint, you see it refers to separation of duties again. Effective separation of duties requires that costs be determined from cost information, which is independent of the production area. Right? The production area should not be responsible for determining what the costs are in terms of having access to the actual source documentation. Right? The source documentation with respect to preparing the costs of the production should be independent of the people actually doing the work and the people doing the supervision. Right? We don't want them actually recording the cost and actually being in charge of controlling the labor. Right? Those are incompatible functions. We need the cost information accumulated separately from the actual supervision of the people. Periodic reconciliation. Of course, when we account for our costs, we have to, on occasion, and we've discussed this briefly back in the purchase payable payment cycle, we perform periodic reconciliations. So the idea here is simply, as we're accumulating costs, we should be producing inventory, right? And so let's say we spend X dollars. So for example, let's say we spent $1 million. For that $1 million, we should have been able to produce 10,000 units of inventory. So we should actually count, right, from time to time, how many items do we actually have compared to the costs that we've actually incurred. Right? So we want to reconcile the physical assets, the actual inventory that we should have been able to produce based on their costs, to the actual inventory that we actually have. Right? So we don't want to, if $1 million should have produced, for example, 2,000 items, we would hate to find out we spent all that money and produced only 1,000 items, right? So we want to reconcile the number of items that we should have on hand to the actual items that we do have on hand. That's going to tell us how accurate our inventory accounting is, right, in our accounting records. So again, just like a bank reconciliation, reconciling the bank account from our general ledger to the actual money in the bank according to the bank statement. Here we're simply reconciling the amount of inventory that our accounting records say we have to the actual physical inventory that we have, right, in our plant. Now again, most companies only do that once a year because typically they have to shut down their production process in order to count their inventory. So it's actually a very expensive process for them. Some companies, large multinationals, they do count inventory more than once a year, but not their entire inventory. They perform what's called cycle counts. A cycle count typically is where you will take your most valuable inventory and maybe count that once or twice a year. But your smaller items, small cost items, you may count those items more often because if they're smaller cost items, they could disappear more easily, right? Be stolen, etc., by employees or others. So companies will do test counts on those items throughout the year, right? So they might count smaller cost items maybe twice a year or 3 times a year. Okay. So the more you're counting, the better control you have over your inventory because you're going to be reconciling, right, the actual number of items you have on hand to your accounting records. Right? Anytime we're doing the reconciliation process, that's a control itself, right, over inventory costs and over the number of physical units we actually have. So just like bank reconciliations are very important, accounts receivable reconciliation, where we reconcile the balance in the account receivable general ledger control account to the account receivable subsidiary ledger, which lists all the individual customers that owe us money, right? Very important for all those reconciliations to be done because that's how we find errors. And when we find errors, we can take action, right, in the future in the context of our inventory to be able to better control inventory costs. Okay, as we've seen in the other accounting cycles that we've looked at, a lot of information can come these days from computerized reports. And again, if you look at page 590, where it talks about the production cycle, there's a lot of different computer reports that are actually produced with respect to the cost being incurred to produce the actual inventory. So as we see here in the PowerPoint, it says production accounting systems produce timely reports to supervise and control production. Right? Those production reports are going to tell us how many items are being produced and what's the cost to produce those items. Right? So the more reporting we can have done by our accounting system, the more information we're going to have in order to control our costs. And if we can control our costs, that means we should have more accurate information with respect to determining what the cost of our inventory is. So as we've already talked about, a sales forecast, right, that provides the basis for which we're going to actually produce the number of goods. Okay. So it suggests here, use a sales forecast. It says for the following year to value inventory. So what they mean is the year-end inventory. So let's say, for example, we have 10,000 units in inventory. And when we talk to management about their sales forecast for the year, they say, yes, we're going to sell 2,000 units next year. Well, that indicates you might have a problem, right, in inventory. If you have 10,000 units and you can only sell 2,000 next year, you have 5 years of supply, right, in your inventory. So what's the value of that 5 years supply? Right? It just raises the question about maybe that's something you're going to have to look at because that inventory might become obsolete in 2 or 3 years. Right? Or maybe it's obsolete today, right? Depending what it is. So you'd have to get into the detail to make an assessment. So sales forecasts, yes, can be an indicator, right, of possible future value. The next point, the various production plans and reports that are produced, right, with respect to the cost build up for the inventory that's being actually prepared. Those reports, of course, can be used, it says, to determine the cost valuation of inventory. What are the actual costs being incurred, right, to actually run our plant, for example, to actually pay our labor, to pay for the raw materials. So as we're accumulating that actual cost information, we're going to use that information to calculate our actual unit costs and be able to compare that to what our target unit cost was. Right? If we thought we could produce the item for $60, are we? Or is it costing $65? Or is it costing $55? Right? So if there's some variance from the plan, as we mentioned a few minutes ago, we'd want to investigate that, right, to ensure the accuracy of the cost of our inventory. So the more controls we have over production reporting, right, it should allow us to better control our inventory costs, right, and ensure that it is accurate. The last item mentioned here, amortization. Because we're talking about manufacturing overhead, right? So manufacturing overhead, again, if you have a manufacturing plant, the manufacturing overhead would include things like insurance on the building, right? Utilities operate the building, property taxes paid to the local government, right? Heating costs, air conditioning costs, all these costs that are incurred to actually maintain the building so you can actually carry on your production process. That's what we call manufacturing overhead. On the labor side, indirect labor is included in manufacturing overhead. So for example, supervisors, right? The cost of a supervisor is part of indirect labor. The general manager for the manufacturing plant, that's indirect labor. They're not actually working producing the product, they're supervising the people producing the product. Right? So we call that indirect labor. That's part of the overhead component cost. So with respect to all those overhead costs, we have those, but then we also have depreciation. Right? So as we use up our equipment, as we use up the plant in which we're actually doing the manufacturing production, right, we're going to have to record the depreciation for the use of those assets. So in terms of our production, okay, we also use those reports to determine what our depreciation is actually going to be for the assets that we're using up. Because typically, the more production we're using, or we're producing, more items we're producing, the faster we're using up our equipment, the faster we're using up our building. Right? So those things are going to essentially flow together, and we can use reports from production to determine the influence on what our depreciation charges should be during the year. So we have these various areas of control: authorization, custody, computerized reports, record keeping, periodic reconciliation, right? So these are the common controls that should exist in this cycle. We've seen them before, right, in the other cycles. And so given those controls, we know that the auditors have to make an assessment, right, of the internal control risk. So again, looking at the PowerPoint, it says control risk. So again, that's internal control risk assessment. Why do we do that? We do internal control assessment because we have to determine the effect of the internal control risk on the nature, timing, and the extent of the substantive audit procedures. Why? Because again, think back to before the midterm, we talked about the audit risk model. Right? Audit risk equals inherent risk times control risk times substantive risk. Right? And so we have the three risk components, and we said inherent risk and control risk. We combine those risks together and call that the risk of material misstatement. Okay, so we have to assess as auditors what is that risk, and so that's what they're talking about here. Because we know if internal control risk is higher, right, meaning that the control system is poor, our detection risk has to go lower in order to maintain audit risk at no more than 5%. How do auditors lower detection risk? They would have to do more work, right, to lower detection risk. On the other hand, as we've said before, if control risk is low, control risk is low because internal control systems are strong. And if internal control systems are strong, that means IR times CR is lowering, it's decreasing, so auditors can allow detection risk to increase. Again, with the goal of ensuring audit risk is less than or no more than 5%. Okay, so auditors are always balancing the two, right, between how much is my control risk, how much is my detection risk, and determining their substantive procedures in light of that assessment. And when we talk about substantive procedures, we've mentioned, again, we have different types, right? Two types: tests of detail, where we look at actual accounting records, source documentation, and analytical procedures. Control risk assessment can affect the timing of our substantive procedures. So if control risk is low, that means internal control system is strong, and auditors can do more of their substantive tests before the end of the year. On the other hand, if control risk is high, that means the internal control system is poor, so auditors have to do more work towards the end of the year or even at year end. And then the extent, of course, if control risk is high, auditors must do more work, right, to lower the detection risk. On the other hand, if control risk is low, that means the internal control system is strong, so auditors can reduce the extent of their substantive procedures. Okay? And the same thing applies here in this cycle. So auditors are going to have to make an assessment of the internal control risk in each of the accounts. And so in the accounts, we have the various inventory accounts that we've already mentioned: raw materials, work in process, and finished goods. We have cost of goods sold, right, which is simply the flow of costs from the inventory accounts into the cost of goods sold. And then we know we have the amortization that we mentioned a few minutes ago on the equipment that we're using. That is going to be recorded as an expense, of course. And when it says accumulated, it just means it's recorded in the accumulated depreciation accounts in the general ledger for the various assets, such as the various types of equipment and the building, perhaps. Okay. As we've seen in the other accounting cycles, when we talk about control risk assessment, we can look at the general controls in the cycle, and then we can look at the application controls. So if you go to page 599 in the text, just turning there myself. Sorry, I went a little too far. Page 595. Okay. Page 595, you'll see the paragraph there talks about the general control considerations. So again, general control considerations, looking at the PowerPoint, proper segregation of duties, right, is always the key one. So we're talking about segregation of duties amongst what? Those control areas we mentioned a few minutes ago. Separation of authorization of production from custody over production, labor and goods in particular. The recording function, which should be separate from authorization and custody, and then the periodic reconciliation. Reconciliation should be done by persons independent of the processes, right? And that's what they're talking about in the next two bullet points. It says custody of inventory in the hands of persons who do not authorize or account for production. Right? So the people who have physical control over the inventory should not be involved in authorizing the purchase of the inventory, and they should not be involved in the accounting for production costs. They're just controlling the physical flow. They're receiving the goods, right, that are purchased, and as they're released into production, they get a bill of materials. So they're controlling the actual quantity, right? So those, again, should all be separate functions. Similarly, the next bullet point says cost accounting. So that's the persons actually determining the unit cost of the inventory. That should be performed by persons who do not authorize production, okay, in terms of the number of units that are going to be produced, or have custody, right, over the production assets, such as inventory. So again, as we saw in the other cycles, there should be separation from people who control physical goods to people that are making accounting entries, right? Because if you mix those duties, right, if I actually control the inventory, I could make a journal entry to reduce our inventory and charge that item off the cost of goods sold, right? I just do a journal entry, debit cost of goods sold, credit inventory, and I take that item of inventory home with me at night. Right? So if there's inadequate physical control and then poor segregation of duties, where people can falsify journal entries because of the poor segregation of duties, of course, this is going to be a problem. Right? So again, on page 595, they list some of the more common general control considerations that you might want to look at. Then on the next PowerPoint, it mentions other control considerations. So these are other types of controls that can exist in the actual production process. So again, this is discussed at the bottom of page 595 and over on the next page, 596. So let's just look at the PowerPoint for a minute. It says, first, production orders contain a list of materials and their quantities, and they are approved by a production planner. Right? So somebody's saying, yes, those are the materials that we need, right, in order to produce a certain quantity of goods. And it's on the basis of the production plan that someone's going to go out and actually purchase those items. Right? Someone should not be going out and purchasing items if we're not going to use those items to actually put them into the production process, right? It wouldn't make sense. So the production orders, right, will contain this information that the purchasing department will use. Okay, so the production people will advise purchasing, next month we're going to produce 1,000 units. To produce that 1,000 units, here's what we need in terms of materials, right? And please go purchase those. So production's authorizing purchasing to go out and buy the goods based on the projected use needs. The next bullet point, material requisitions, it says are compared with a list of materials on the production order and approved by the production operator and materials inventory stock keeper. So a material requisition, again, is simply if we need goods moved to the actual manufacturing floor, the shop floor, from inventory, that's going to be done on the basis of what? A production order. Right? So maybe in our inventory, we have 10,000 units we purchased, but we only have to move 100, right, into our actual production. So that's going to be done on the basis of material requisition. Somebody's going to requisition 100 units from the storage area to move into the production line. Okay? And of course, the person who has physical control over the inventory is not going to physically release inventory until they have a material requisition, because that's the authorization to remove the inventory out of custody that they have. Job labor time records are signed by production supervisors, and the cost accounting department reconciles the amounts with the labor report from payroll. So what we're seeing here, as people actually work on jobs, they're going to record their time. That time charged to the job is approved by their supervisor, right? So we know Mr. X worked for 10 hours on a particular job. Mr. X is going to be paid, right, from payroll. How many hours should Mr. X be paid for? 10, because that's how many he's worked, right? So the cost accounting department, they're going to say, here's a report from payroll that says Mr. X was paid 10 hours. Here's a report from production that says 10 hours were charged to job A. Right? So the items match up. Right? So we want to make sure that the payroll that we're actually paying is being assigned to actual jobs. Right? And so that means that the money we're actually spending on payroll is productive. Right? We're actually using their people properly in terms of allocating their costs to actual jobs. If we found out that the job labor cards, let's say, just say Mr. X charged 5 hours, but Mr. X got paid 10 hours, well, why are we paying people 10 hours when they're only working 5 hours on jobs? We should have them working more hours on jobs, right? Because if they worked for 10 and we only assign 5 hours to jobs, then we're wasting 5 hours of time, aren't we? So looking at and comparing the time charged to jobs to the actual time we're paying for it is a very important control over costs, right? Because if we constantly have a position where only people are only charging 5 hours but getting 2 jobs but getting paid for 10, that probably tells us we can reduce our workforce by 50%, right? Just have enough people so that we pay people 5 hours and they work 5 hours. Right? So again, monitoring of our costs to make sure our resources are not wasted. The next point, when finished goods are actually complete, it says production reports of finished goods are signed by the production supervisor and the finished goods inventory custodian, and then forward to cost accounting. Right? How many units were produced? Right? So when the units roll off the line, right, the actual production report for the day is going to say we produced 500 units today. Where did those 500 units go? They went into inventory. Right? So they went into a storage area, and the custodian over the inventory, right, is going to actually sign that they received 500 units from production. That information about the number of units that went into inventory goes to cost accounting so that they know how many items they have to account for. Right. So again, we see segregation of custody, right, over the actual inventory from the actual accounting for the inventory, because the people in cost accounting provide a check, right, on the items produced, how many we have, as well as the total cost, because cost accounting is getting the cost independently of the production people. Okay, the next point says controls should produce evidence to allow for detailed control checking procedures. Well, again, that's what we're doing, right? We're looking at what types of reports should be produced so we can check, right, whether the right quantities appear to exist, whether the costs being incurred are on budget or not, right? So the more reports we have, the better we can actually control inventory quantities and inventory costs. Because as we started out today, we said inventory consists of two things, quantities and costs. So we want to make sure we have proper controls in our production cycle to control inventory units and inventory costs. Of course, we've already mentioned today, computer reports, of course, in order to monitor the movement of actual goods, right? So how many pounds of raw material did we have? How many pounds of raw material did we move into production today, right? So we'll generate reports to tell us, we had 100,000 pounds of raw material, 10,000 went into process today. So we credit raw material inventory, debit work in process inventory, right? So we can have reports that help us make the accounting entries. Of course, the more reports we have, the better we can monitor the units and the costs associated with the units. We've already talked about in the exhibit, appendix 13, at the end of the chapter, again, there's an internal control questionnaire with respect to the general controls that are discussed in this particular cycle. Again, those are listed on page 595, okay? But there's more detail in the internal control questionnaire, so you may want to have a look at that as well. Okay, let's go forward from there. One thing that we've seen, as we've talked about all the accounting cycles, is that when we test internal control, we have to ensure that the control tests cover off all the control objectives, right? So if we go back to chapter 8, you might remember the chart we had that talked about control objectives and actual internal control procedures, assertions made by management. You might want to reference back to that. But we have to test, for example, the existence of inventory. We have to be able to test valuation of inventory, right? So all of these audit assertions have to be checked by the internal control system. So we're going to do various checks. Now, in this particular cycle, again, it talks about dual direction of testing. Okay? And dual direction of testing is discussed on page 600, sorry, not 600 yet, 596, right? 596 in the middle of the page. Again, it talks about completeness and validity. So if you wanted to test inventory for completeness and validity, how would you do it? Well, let's say at the end of the year, right, management produces an inventory list and says, here are 10,000 items of inventory. Well, we're going to do an inventory count, right, on the year-end date. So how do we test for validity? In that case, we would take management's list of inventory and trace back, go find the physical goods, right? So we take management's list and go find the physical goods that match that list. We are verifying the validity of inventory. On the other hand, if management gives us a list of inventory, how do we know that all the items that should be on that list are actually on the list? So to verify the completeness of the inventory list, we will go to the actual shop floor, right, during the inventory count, and we'll select a number of items. And we'll trace those physical items onto the inventory list. So we've talked previously what happens when management does an inventory count. They usually use a tagging system, right? So they'll have tags numbered from, from 1 up to whatever number that they're using. They account for all the tags, okay? And as they record their inventory, they say on tag 1, right, there's 100 units of product A. On tag 2, there's 50 units of product B, etc. And so when you're out on the shop floor, you'll select a tag number, right? So let's say you select tag number 68. And you go and see, is tag number 68 recorded on management's inventory list or not? Of course, it should be, right? If it is, that means management's inventory list is complete. If it's not, it's an indication there's a problem, right? And all the inventory that should be on the list maybe has not been reported for some reason. Right? So we'd have to get into finding out why is all the inventory not actually recorded. Now, with respect to control tests, there's an example of control tests on page 597. So in the PowerPoint here, it says, you see Exhibit 13-9, control tests for work in process inventory. So again, there's an example of the control tests there. And I'll suggest have a look at those because they match up the actual procedure with the actual control objective. Okay, so in the right-hand column on page 597, you'll see it says control objective, accuracy, validity, completeness, etc. And it tells you the type of test that you would do over the work in process inventory. Again, the reason I'm suggesting you have a look at that is just so you get an idea, right, in terms of, what type of a control test relates to a certain type of objective, okay? So when we get to the final exam, I'm not going to ask you, list 4 procedures that you might cover in an audit of work in process inventory to verify certain audit objectives, right, according to page 597. It won't be like that, but I might ask you, you're in a manufacturing setting, you have inventory lists created by management. How would you verify the validity of the items recorded on that list? Right. So as I just said, for validity, you would take items on the list and go find the physical goods. Or I might say, okay, management has a list. How would you verify the completeness? Again, that would be going find physical goods and then trace them onto the list, right, to make sure that all the physical goods are actually recorded on the list, right? So it'll be more of that, I'll say, generic or general type questioning, right, as opposed to asking for lists and things like that on the various text pages that we're looking at. And that's the reason I'm giving you some of the assigned problems right out of the text and then posting the solutions is to help you get used to that process, right, of actually being able to understand how controls are tested. And also the other important part is looking for weaknesses, right, that exist in the internal controls of a company. And so hence that's the group project, right, that you're working on to find control weaknesses because that's exactly what you do, right? If you're a member of management, you're going to try to identify internal control weaknesses so you can strengthen the internal control system so that the auditors can rely upon it. So it's very important from a management perspective, but that means you have to understand internal control to some degree. So tackling those types of the group project and then looking at these other detailed problems that we're looking at in the chapter will help you develop some skill right in doing that type of thing. And at least when you interact with auditors and they're talking about internal control, you're going to have some understanding as to what internal control is. You may not be an expert, that's fine. We don't expect you to be an expert after one course in auditing, but you're going to know enough that you'll be able to understand what auditors are talking about and be able to participate in the process, right? Because you have some level of proficiency. Okay. Now, they mentioned exhibits 13-10 and 13-11 in the text, and those are on page 597. Okay. And those tests, again, as I point out in the PowerPoint, it says those exhibits illustrate procedures to test the production accounting in two directions. Sorry, it's at the bottom. I think I mentioned page 597. Okay, bottom of page 597, and the next one's at the top of page 598. But again, we've already talked about two-direction testing. So again, that's where you have the inventory list. Right? How do you test validity? How do you test completeness? That's testing in the two directions. And I think I've mentioned before, usually on the final exam, I do have a question around directional testing, right? Because that's important to determine that you're actually testing in the proper direction in terms of verifying the actual assertion that's being made, right? Whether it's validity or whether it's completeness, or perhaps even other audit assertions. The summary of our control assessment in terms of how it affects the substantive procedures we've already talked about, right? So again, good internal controls means internal control risk is low. The effect on substantive procedures, we have smaller sample sizes, meaning we do less work, and we can do more of our work before the end of the year. That's what they mean by earlier timing. If internal control is poor, that means internal control risk is high, and where internal control is poor, that means the auditors must do more work. So they're going to have larger sample sizes, and they're going to take less risk, right? The way auditors take less risk is they do more work at the end of the year as opposed to earlier on. Okay. So again, that's the logic that we've been looking at in each of these particular cycles. Now, the actual substantive audit program they mentioned here. So we've talked about internal control today, but we know auditors always have to do some level of substantive audit work when they conduct their audit. So it refers to exhibit 13-12. Again, that exhibit is on page 600. Okay, so you can have a look there at the various types of substantive procedures that auditors use in the production process. But what you're going to see is a lot of what they do is actually analytical procedures. Okay, so the top half of this PowerPoint we're looking at. With respect to analytical procedures, again, this is very easy to do, right? Assuming you're in a computerized environment, which virtually all production companies are today, right? They're producing all types of internal reports. So you can look at the gross profit margin, right? Over a period of time. What was the gross profit margin this month, right? Compared to last month, maybe compared to the same month last year. And we want to look at not only total gross margin, but we want to look at it by product, right? So detailed gross profit. Various companies that actually run production processes, they produce detailed accounting records that shows you gross profit by product. And if you know gross profit by product, that's a way of controlling costs, isn't it? Because someone's actually looking and saying, our gross profit percentage should be 60%. And as long as it is 60%, that means our costs are properly controlled, right? Because if our gross profit margin is 60%, that means our cost of goods sold is 40%. And if it's maintaining that trend, we're controlling our costs properly. Our internal control system is working. But if we see variations, right, in the gross profit percentage over the months that we're comparing, that's an indication that there may be a problem, right? Because most of the time, for most products, the gross profit percentage stays fairly consistent. It doesn't change very much. So if you're seeing fairly large changes in the gross profit per product, it's an indication that there's something wrong, right? So normally what you want to compare the current month usually to at least 2 months previous, right? Because month to month, you can have little blips, right, between one month and the next month. You may even have cutoff errors between accounting periods. So normally what you want to do is take the current month and look at the last 2 months. Maybe look at the same months last year, right, as an indicator as to whether the costs are properly being maintained by looking at the gross profit margin by product by month, right? So fairly detailed reporting, obviously you need to actually do that. But we actually look at analytical procedures. Again, we mentioned the controlling of costs and inventory. So another thing you would find out is that for most companies, the ratio of their raw material costs to their total inventory is consistent year to year, month to month. So typically, let's say, at the end of last year, raw material inventory was 10% of total inventory. What would you expect it to be this year? Probably 10%. If it's not 10%, if it's vastly different from that, why is that? What happened, right? We'd want to get into that. Work in process inventory normally might be 20% of total inventory costs at the end of the year. If it is, we would expect it to be 20% this year. If it's not, why not? Right? We would get into that and try to understand why the work in process percentage is different. Right? Maybe work in process is higher at this year end because they had the shutdown because of COVID, and now they're ramping up their production. Right? So work in process inventory is a much higher percentage. Right? So as long as we can understand and rationalize how the numbers are moving, that's what auditors are looking for with respect to analytical procedures. Okay, so in this area, very important, gross profit, right, by product, and also looking at the relationships of the inventory accounts to each other at the end of the year, at the end of the month. Compare this month to last month, compare the end of this year to the end of last year. In most businesses, there's a lot of consistency. That's what we call analytical procedures. There's internal consistency because you have the same management running the business, right? Typically year to year, they're using the same strategies typically year to year. And so the results are typically the same year to year, right? So it all makes sense in that way from the auditor's perspective. So analytical procedures, again, we know are very efficient, right? Doesn't take a lot of time to crunch some numbers, to do comparison, to calculate some ratios. Or it doesn't take long to look at a computer report, right? That's actually generating data for you to look at gross profit by month, by product. Excuse me. Okay. In addition to analytical procedures, though, auditors normally will also do a limited amount normally of substantive procedures in this particular cycle. So with respect to the various types of inventory we have, what might be some of the substantive procedures in terms of tests of detail, right, that auditors might do? Well, for raw material inventory, it says agree to supplier invoices, right? So what's the actual cost of the inventory? Well, go look at the invoice from the supplier, right? If our costing records say the cost is $10 per item, we should be able to go to a supplier's invoice and see where we've been billed $10 per item. So we're tracing to the actual source document, right? These are tests of detail. Work in process and finished goods. It says review the cost elements and costing calculations by product for accuracy and completeness. Compare labor rates used for payroll records. So again, in work in process, for example, there'll be a raw material component, right, and there'll be a labor component, and there'll be an overhead component. So let's say raw material cost is normally 10% of the total work in process cost. Is it this year? Right? Is it this month compared to last month? These internal ratios with respect to these inventory accounts are very consistent normally. Right? If labor cost is normally 40% of the work in process cost, that should be pretty consistent year to year because we're producing the same product, we're using the same amount of direct labor, so the direct labor portion of the total work in process and finished goods cost should be consistent year to year. So auditors are just reviewing it to ensure that it is. If it's not, then we have to go deeper, right, and understand why isn't it. Now, when we get that information, of course, labor cost we know is labor hours, right, times pay rates. So pay rates, we can actually go to individual contracts with respect to what people are being paid. Or, of course, if there's union agreements, you can go to the union agreement and say, here's how that person is being paid. Okay. And then, of course, one of the most important items when you value inventory is how much overhead cost is assigned to inventory. And so we have to look at the actual overhead calculations to determine whether they are reasonable or not, right? And so that's an actual physical calculation, taking all of our overhead costs, right, the number of units produced, to see if we're assigning overhead costs properly to inventory. But again, normally, right, for both work in process inventory and for our finished goods inventory, the overhead cost as a percentage, right, of the total work in process cost or as a percentage of the total finished goods cost is usually consistent, right, year to year, month to month. So again, even though we will do some substantive tests to ensure that the overhead application rate is reasonably correct, we can also, of course, do these comparisons, right, of the overhead component of our total cost to ascertain is it reasonable or not. If it's reasonable, it looks fine. If it's not reasonable, then of course we have to actually go further. Okay. So yes, in this particular part of the inventory process, the production process, there are some limited tests of detail performed because auditors always have to do some tests of detail, but we rely a lot, right, on the analytical procedures, especially in large companies that have good internal control systems, right? If they have good internal control systems, it probably means that they're producing a lot of computer reports over production. So you will be able to look at, right, gross profit by product over each month, for example, right? That information is available for you to look at. Okay, a number of this last slide just talks about a couple of cases that are included right at the end of chapter 13, talking more about payroll problems. The first one, it says ghosts on the payroll. So that's typically what we call a ghost, is when someone is on payroll and is being paid, but they don't actually exist. Right, so that case actually talks about that. So you might want to look at that. That's right at the end of the chapter. And then the second one is called unbundled before it's time. It says production sold as finished goods before actual unit completion caused understated inventory, right, and overstated cost of goods sold. So, how can we actually record sales before production is completed? Well, why would we do that? Because we want to show higher sales, more profit. And doing it before our production is completed means that our cost is lower, right? Because we haven't recorded all the costs yet to actually complete the sale, right? So that's an interesting case too, if you want to look at that. Now, the other day I'll just mention the three cases again that I'd like you to look at. Discussion case, DC 13-1, DC 13-4, and DC 13-5. Again, these three cases deal with the payroll system and the production process. So we'll actually give you some hands-on experience in terms of actually analyzing what's going on and determining what the problems are. Again, over the weekend, I will be posting the solutions for those cases so you can judge your own work and see how you're doing. If there's anything you don't understand, of course, certainly send me an email, and I'll be available to get back to you. Okay. Other than that, so today's lecture is a little shorter, so I'd encourage you to have a look at those 3 discussion cases, okay, for the balance of our class time today, and then have a look, obviously, at the solutions over the weekend to confirm what your thinking is and your understanding. Okay. Then next week, if you want to start reading ahead, obviously we'll be looking at chapter 14, dealing with what we call the investment and finance cycle. And what we'll see there is the investment and finance cycle. Auditors do not generally rely on internal control at all. The main reason for that is that that cycle differs substantially from the other cycles that we've been talking about. And the way it differs is that if you look at or think about the sales cycle has many transactions, right, during the course of the year. Or if you think about the purchase payable payment cycle, it has many transactions during the year. The same thing with the production and process cycle, right? It has many transactions in the course of the year. But the investment and finance cycle, what we're talking about, for example, by investment, we mean purchasing another company, right? So buying a subsidiary, for example, or it might be just buying another business as opposed to an actual company, buying assets instead of buying shares. Okay, it may actually just be investing our excess cash and how we do that. Finance talks about raising capital, so borrowing money, issuing a bond payable, for example, or negotiating a new loan with the bank, or if we're a public company, issuing shares, right, to the marketplace. So all of these things are transactions which do not recur on a daily or monthly basis, right? They're irregular transactions. They only occur on occasion. Some of them don't even occur every year. It might be every few years. Some of them it may be never, right? We may never buy a subsidiary, for example, right? So all of these types of things, they're irregular. So from an audit perspective, why would auditors spend a lot of time investing internal control or investigating internal control over investment and finance cycle when there's very few transactions? Wouldn't make a lot of sense, would it? So that's the answer. The auditors don't do that. The auditors do virtually 100% substantive procedures over the investment and finance cycle. So the one reason they do that is because the number of transactions is irregular. The other reason it's 100% substantive is because those transactions are material, right? They're virtually all material. So when a company does one sale of a unit, is that material? No, it's not, right? It's only one item out of 3 million that they're going to sell this year. How about a purchase? We purchase raw materials. Is that material? No, right? Because we're going to do that 400 times during the year, right? The small purchases are smaller, they occur frequently. So we have to have good control over that cycle. But in the investment and finance cycle, we're just talking essentially about the one-off type of situation. So there's a lot of management control over those transactions. They're heavily involved, right? That is the control, really, is top management. But of course, auditors, because the transactions are significant and material, of course, have to gather audit evidence to support their audit opinion. Right? So those types of transactions, they're always audited 100% on a substantive basis. Okay, so we'll talk obviously more about that next week. That'll be kind of an interesting week because we'll talk about both investing of money and raising of money. So just the topic itself is also interesting, but also the different audit approach to it versus what we've talked about in the other cycles, you'll find probably refreshing to some degree compared to talking about the detailed controls in each of these cycles that we've talked about so far. Okay, so have a good day, everyone. Again, please spend the extra time from class today in looking at those discussion cases. And then next week, move forward, as I mentioned, in chapter 14. Okay, take care, and we'll see you next week.